Step onto any retail trading floor, scroll through modern finance subreddits, or tune into the daily noise of mainstream financial television, and you will hear a consistent, highly predictable narrative. The artificial intelligence and high-performance computing revolution is primarily a silicon story. Investors obsess endlessly over advanced node transitions, gate-all-around transistor architectures, advanced packaging constraints, and the microscopic physics of etching ever-smaller circuits onto silicon wafers. Yet, while the public eye remains transfixed on the microchip, a colossal macro-physical bottleneck has completely shifted the battleground of modern tech supremacy from the clean room to the electrical substation. We have entered an era where raw computing power is no longer limited by how many transistors you can squeeze onto a die, but by how many megawatts of raw, unmitigated electrical power you can pull from a grid that is running dangerously close to structural collapse. This brings us directly to KEEL Infrastructure Corp., trading under the ticker KEEL on the NASDAQ, sitting right around $3.32 per share. To the casual observer scanning financial screeners, KEEL is frequently misclassified through a legacy lens inherited from its previous corporate life as Bitfarms, viewed simply as a commoditized cryptocurrency miner tethered to the volatile, emotional swings of digital asset prices. This is a profound, multi-billion-dollar mispricing. Wall Street's legacy models and short-term algorithms are entirely failing to price in the radical corporate metamorphosis that has transformed KEEL from a basic digital asset validator into a premier pure-play digital infrastructure and energy titan. The market is currently treating a scarce, highly coveted portfolio of energized power assets and brownfield industrial campuses as if they were mere server shacks exposed to coin volatility. The hidden structural reality that institutional media completely misses is that power, specifically reliable, low-cost, grid-interconnected electrical capacity with immediate multi-hundred-megawatt availability, has become the ultimate scarcity currency of the 21st century. Hyperscalers and sovereign AI labs are currently facing multi-year queue times to connect new data center loads to congested transmission grids across North America, while tech giants scramble to secure power purchase agreements that are years away from actual substation delivery. KEEL sits on an existing, strategically localized portfolio featuring over 340 megawatts of energized capacity and a staggering 2.2 gigawatt multi-year development pipeline spanning high-demand power markets in Pennsylvania, Washington, and Quebec. Retail investors glued to short-term momentum charts are panicking over nominal share price movements, completely blind to the fact that the company's underlying real estate and grid interconnections represent irreplaceable physical assets. In an environment where obtaining a new grid interconnect can take 5 to 7 years due to regional transmission organization backlogs, owning brownfield sites with legacy power allocations is the structural equivalent of holding waterfront property in Manhattan during a land rush. The market mispricing persists because passive index funds and algorithmic trend followers are slow to re-architect their valuation frameworks for a company that has successfully pivoted its entire identity towards high-performance computing and AI workload hosting. Market dynamics and institutional positioning. A closer inspection of KEEL's daily trading volumes, order book dynamics, and institutional accumulation patterns reveals a classic Wall Street accumulation playbook unfolding in real time. Amid broader macroeconomic jitters, interest rate uncertainty, and intermittent sector rotations, retail traders are getting aggressively shaken out by sharp price volatility. Automated trading desks and quantitative short-term momentum algorithms exploit this retail anxiety, triggering stop-loss orders and driving shallow pullbacks that create an illusion of weakness. Yet, behind the scenes, smart money institutional heavyweights are methodically absorbing every available block of shares. The daily volume profile demonstrates a distinct pattern. Retail-driven sell-offs during morning hours are consistently met by large iceberg-style institutional block purchases near technical support levels, signaling high-conviction long-term sponsorship. This institutional accumulation is not driven by quarterly earnings beat or miss cycles, but by a strategic recognition of replacement cost economics. When you calculate the capital expenditure, permitting hurdles, environmental reviews, and transformer lead times required to build out a 2.2 gigawatt infrastructure pipeline from scratch, KEEL's current enterprise valuation tells a story of profound disconnection from intrinsic asset value. While casual market participants debate day-to-day fluctuations on financial streaming platforms, institutional accumulators are treating the stock as a call option on the physical expansion of the global artificial intelligence economy. They understand that as hyperscale cloud providers exhaust available power in primary data center hubs like Northern Virginia, capital must aggressively rotate towards secondary and tertiary power-rich jurisdictions where KEEL maintains an established operational footprint. Before we dive deeper into the operational mechanics, let us pause right here. Are you currently holding a position in digital infrastructure and power plays like KEEL, or are you sitting on the sidelines waiting for a deeper macro pullback to establish your cost basis? Drop your thoughts in the comments below. Business model and historical context. To truly grasp why KEEL represents a paradigm shift in digital real estate, we must dissect its operational DNA and discard the outdated historical framing that haunts its ticker symbol. For years, the company operated under the legacy framework of a traditional cryptocurrency mining enterprise, acquiring land and electrical transformers solely to power application-specific integrated circuits dedicated to blockchain validation. While that foundational chapter provided crucial experience in high-density electrical management, liquid cooling deployment, and continuous load balancing, looking at KEEL today through that narrow aperture is like evaluating Amazon in 2010 as a simple online bookstore. The modern operational model of KEEL is anchored in the ownership and strategic development of high-performance computing and AI data center campuses. The company's core assets, spanning prime locations such as Moses Lake in Washington, Panther Creek, Sharon, and Scrubgrass in Pennsylvania, alongside Sherbrooke in Quebec, are masterclasses in geographic and electrical positioning. For instance, the Pennsylvania footprint places KEEL squarely inside high-demand, constrained power markets, where legacy industrial and energy brownfields provide immediate access to robust transmission lines. These are not mere warehouses with rows of desktop computers. These are institutional-grade digital infrastructure campuses engineered from the ground up to handle the immense thermal loads, massive power densities, and low-latency fiber connectivity demanded by modern artificial intelligence clusters. Furthermore, the geographic distribution of these assets offers a structural operating advantage. The cooler climates found in Washington state and Quebec naturally facilitate free cooling efficiencies, drastically slashing the power usage effectiveness metrics that define modern data center profitability. By integrating power, land, and connectivity into a unified operational framework, KEEL has positioned itself as an indispensable landlord to the digital age. As enterprise customers and AI developers face a severe drought of viable server housing, companies that own fully energized real estate with ready-to-deploy electrical capacity hold all the economic leverage. The transition from mining digital coins to hosting multi-tenant high-performance computing workloads has fundamentally altered the company's risk-reward profile, converting volatile coin reward cash flows into highly predictable long-term leasing revenue streams. Future outlook, catalysts, and risks. Looking over the multi-year horizon, the growth catalysts driving KEEL are deeply intertwined with the unprecedented capital expenditure supercycle currently being unleashed by mega-cap tech spenders. Hyperscalers are pouring hundreds of billions of dollars into artificial intelligence infrastructure, yet their expansion plans face an immovable wall of electrical grid constraints. This structural bottleneck elevates companies like KEEL from standard real estate operators to critical technological gatekeepers. With a multi-year pipeline scaling up to 2.2 gigawatts of total capacity, KEEL possesses the exact inventory that large-scale cloud providers and sovereign cloud initiatives desperately need to prevent their expansion roadmaps from stalling out. The technological roadmap within KEEL's campuses is explicitly aligned with next-generation high-performance hardware, ensuring that its facilities are custom-built for high-density GPU deployments rather than legacy computing setups. However, navigating this high-stakes landscape is not without its risks. The company remains exposed to regulatory shifts in energy markets, evolving transmission tariff structures, and the complex geopolitics of cross-border supply chains for critical electrical infrastructure components like large-scale step-down transformers and high-voltage switchgear. Additionally, any volatility in power pricing or changes in regional grid operator rules can introduce localized margin pressures that require sophisticated hedging and long-term power purchase agreement structuring. Yet, despite these operational complexities, the overarching macro thesis remains overwhelmingly